Tax Council. He is the president of the Institute for Research on the Economy, upon the Economics of Taxation. A distinguished economist, and will make a tremendous addition to this discussion of Reaganomics and the future of the United States. Steve.
Thank you very much. It's a pleasure to be here. And is that better? Yes.
Yes.
Okay.
Good.
When in doubt, read the instructions. When all else fails, read the instructions. All right. I had the honor of serving President Reagan as Deputy Assistant Secretary for Economic Policy at the Treasury. I was an economist, not an attorney, but please don't hold that against me. Prior to going to the Treasury, I served on the staff of the Joint Economic Committee of Congress. I come there from the University of Chicago, where I had met and taken courses from Milton Friedman, Bob Mundell, and became friendly with Art Laffer. And these gentlemen had briefed and assisted presidents before, and when I said I was coming to Washington, the first thing they said, do something about inflation and the tax code. So I worked with Senator Taft and Senator Griffin and a few others to do something about that, and I'll get to that a bit later. But it was a very heady time. Economics was undergoing quite a revolution, and it was undergoing a revolution because the economy was a mess, and nobody at the time seemed to know what to do about it. I see a number of familiar faces here. I'm going to skip through the presentation fairly rapidly and maybe skip some of the charts. I hope that people in the back can go by the numbers of the charts, perhaps, if you see the order on the side. But the first thing that we need to note in the second chart is that current economic troubles are confounding policymakers, and they were confused back in the 70s too, so we have two states of confusion. The legacy that Reagan left us, the things we found out about the economy back then, are equally applicable today. And the approaches to economics that were discovered then and were new then and are controversial then should be natural for us now and are good guides for the future. Unfortunately, we're reverting back to the old pre-Reagan ways of thinking, and that's extremely dangerous. This chart that you see here, and it's also in the larger of the handouts, shows the rising trend rate of inflation over the period, which we managed to reverse. The next chart shows the rising trend rate of unemployment over the period, which we managed to reverse, and the next one shows the rising trend rate of interest rates in line with inflation that we were able to reverse. This progression of worse and worse economics over time, with inflation and unemployment rising, was a mystery to the Keynesians. They had no idea what to do with it. Usually to fight inflation, they put monetary policy on stop, they raised taxes, they cut spending. And to fight unemployment, they let the money supply rip, and they spent like crazy, and they, maybe they did cut taxes, maybe they didn't, but at least that's the way they thought to do these things. But what do you do when you have inflation and unemployment at the same time? They hadn't a clue. Nixon, Ford, and Carter all allowed or even encouraged the Federal Reserve to be very easy. Nixon was horror-struck by the '69 recession and didn't want another one before he had to run for re-election. So he hid the inflation with price controls and urged the Federal Reserve to step on the gas. We then found rising oil prices as OPEC wouldn't take dollars and at the old price level anymore. We had a recession under Ford. We had another recession under Carter. Carter at one point said he was going to cut spending a little so the Federal Reserve wouldn't have to tighten. And the next day the bond market fell out of bed. They didn't know what they were doing. They truly did not. Now, fortunately, back in the 1960s, the monetarists at Chicago began looking at the world and decided they weren't Keynesians. They didn't like Keynesianism, and they thought the whole thing was based on a phony principle. See, the Keynesians felt that if you cut spending, you gave people money. If you increased spending, you spent more, and that would lead to ripple effects. And if you cut taxes, you gave people money to spend, and that would lead to ripple effects. Milton Friedman asked a very simple question of Paul Samuelson, and we put it in a Newsweek article. He said, if the government's spending $200 billion and cuts spending to $150 billion, where does the $50 billion difference come from? The tooth fairy? Well, the answer was no. Either the government borrows the tax cut back from the public, or cuts some other spending, or raises some other tax, in which case you don't have any demand out there, or the Federal Reserve steps in and buys the debt, prints new money. But that's monetary policy, it's not fiscal policy. The monetarists said there were no demand effects from Keynesian maneuverings, and the whole situation was a house of cards. And don't try to gun the money supply to fix things. There's long and variable lags, and you're going to end up with nothing but inflation. Steady as you go. Let the markets adjust. Well, that didn't leave much for Washington to do, so it wasn't a very popular policy set. And at that point, though, the microeconomists are coming back into the field, the old classical economic school, which said that prices are affected by taxes. Taxes are a form of price. When you raise taxes, you increase the cost of something. When you reduce taxes, you reduce the cost of producing something. And it affects the choice between labor and leisure. It affects the choice between saving and consumption. Now, then, if you can skip forward 2 or 3. Stop. One more. The Keynesians had tried some tax cuts in the 1970s. They had increased personal exemptions and standard deductions, and nothing much happened. This was unlike the Kennedy cuts, which had actually done some good. Jerry Ford even tried a rebate. This is a picture of the Bush rebate. I'm sorry, the Obama rebate. There was another Bush rebate in 2001, but this is the Obama rebate. It did nothing to stimulate consumption. It did give you a look at the saving rate, because it was all pocketed. And Ford had gone through the same problem in 1975, to the point where when Carter proposed it 2 years later, Russell Long laughed him out of the Senate. They didn't know what types of tax changes worked and which ones didn't. And in the next slide, we begin to see, another one please, the problem that brought to our attention the right way of looking at taxes was the inflation of the 1970s. The income tax had 14 or 15 brackets back then, and they were very narrowly spaced. And if you got a cost of living increase, you got pushed into a higher tax bracket. And the personal exemption cut increases and the standard deduction increases exempted the first few dollars from tax, but it left the remainder of your income getting pushed up and up and up and up and up through the brackets. For every 10% inflation and rise in wages, the government was raking in about 16% in additional revenue. A 6% real gain to the government from having the Fed inflate. Wasn't much incentive in Washington to fight the inflation. And that's the rising marginal tax rates on the left of the chart. Reagan came in and he rolled those back. That's the shelf that you see in the sort of left center. And then in the Tax Reform Act of '86, you see the big reduction later. But it was those rising marginal tax rates, next slide please, that were causing the problem, and again, there. When you put a tax on something, the cost goes up to the consumer and the sales price goes down to the producer and the quantity shrinks. This is in every textbook. It's well known. If this were a cigarette tax, the Joint Tax Committee would say, yes, if you raise the cigarette tax, you're going to lose some sales, so we won't count all the revenue gain. If it were a gasoline tax, they would say the same thing. But the next chart, please. If we put a tax on labor, we won't count the reduction in the labor force as hurting the economy. We're just going to assume that doesn't happen and there's no economic damage. And in the next chart, if you put it on capital, which really is sensitive to taxation and collapses under the weight, we won't assume any reduction in the capital stock or any damage there, and we're going to assume that it costs every cent that it looks like it costs to cut the tax on capital. When in reality, if you cut the tax on capital, the capital stock grows, and more people get hired, and wages go up, and you're probably going to get a good deal, if not all of your money back. They don't count that. That's called static scoring, and it's why we can't get things done around this town. Next, please. When you reduce the capital stock, you lower the demand for labor and wages and employment fall. Taxing capital hurts the workforce. Next, please. And let's go forward to the next. That's not one, back to, there we go. Higher tax rates obviously reduce incentives to work, save, and invest. And the inflation had driven them up. So as the Federal Reserve tried harder and harder to pump up the money stock to promote economic growth, it drove prices and wages up and tax rates up and the incentive to work higher and invest down. It was a self-defeating program. Now, if you have a program, it's not just the rates, by the way. I want to point out that the base is also important. If you earn your money and you pay your tax and you spend the money on consumption, you've paid one level of tax, and unless you hit something we hit an excise on, like gasoline, tobacco, or bows and arrows and toolbox and fishing tackle, I think we have still taxes on those, unless they've been repealed lately, then you get away with not paying another federal tax on it. But if you take that same after-tax income and you buy a bond, we tax the interest. If you buy a share of stock, we tax your dividends. If you put it into your small business, we tax the profits. If you buy corporate stock, there's also the corporate tax on top of that, which is the third layer of tax on income saved. And if you keep too much for yourself to protect yourself in your old age and you don't die late enough, if you die too early and have something left, the estate tax takes it. Taxes on capital are far higher than on consumption. So many of the provisions in our tax code that move us away from this huge income tax stack of taxes on capital, move us nearer to something called the consumption base or consumed income base. We have pensions that alleviate some of this double tax burden. We currently have a low tax rate on capital gains and dividends that alleviates part of the double tax burden on the corporation. We have had some estate tax relief. We got rid of it for a year and now it's back. But these tax changes in the base, and that includes, by the way, accelerated depreciation in the direction of expensing, are ways of relieving the excess layers of tax on capital. So the rates and the base are both important. One more, please. Another. Those are too small to read, at least I can't see them anymore. But what happened in 1981 was truly remarkable. We had been battling this in the Congress for a long time. We held hearings. I was on the Joint Economic Committee staff. I worked with Senator Bill Roth and Senator Orrin Hatch, who will be here later, I think. And in the House, Kemp had his bill along with Senator Roth to lower the marginal tax rates and explain why it was necessary with the correct explanations. We asked for hearings on the models to see if we could get the model builders in to explain why they didn't take these incentive effects into account in the Keynesian models. And Chairman Muskie resisted, Senator Hatch insisted. Senator Muskie called him paranoid. And Senator Hatch pulled out a letter from the staff director to Mr. Muskie, explaining to Mr. Muskie why Mr. Muskie should not give in to Mr. Hatch's demand for a hearing. It had been fished out of the waste paper basket of the Budget Committee Xerox room by one of Hatch's staff people. And it said, well, Alice Rivlin doesn't want it, and even if we had it, the senator wouldn't understand it. And he's being pushed into this by a right-wing clack. He meant clique. Anyway, the senator said, well, I don't think I'm being paranoid, Mr. Muskie, but if I were, I might have reason, and he read the letter to the committee. Muskie left the room in tears and became Secretary of State 3 days later. In any event, it was a struggle to get people to take this stuff seriously. Even though we had monetarists, we had a lot more research going on in the academic community. We had people like Mike in Boston saying, hey, guess what? Saving is sensitive to the tax rate. You had everybody in the business schools teaching their classes that when you look to see if an investment is profitable, you take the current cost of it immediately, the full cost today, you expense it in your mind, and then you see if the revenues after taxes cover the cost. You don't use some sort of phony baloney strung out depreciation to calculate what the cost of a $100 machine is today. It's $100. It's not $10 a year for 10 years. It's $100 right now. These events in the real world showing that the Keynesian theory did not work and that there were other ways of doing things were coming to fruition, and they led to a 4-part program. The minority on the Joint Economic Committee staff talked about it for several years. And eventually, Lloyd Benson joined us in reports that were both Democrat and Republican saying, plugging in the supply side. He wanted to restrict it to business incentives because he didn't believe in helping the shareholders, but at least it was plugging in the supply side. Well, Mr. Carter was opposing it and Mr. Reagan was endorsing it. Very helpful. Senator Nunn even passed a miniature version of Roth-Kemp. I'm on the House side, I'll have to say Kemp-Roth. They send papers back, you know, if you get the wrong sponsor first, depending on whether you're writing for a House member or a Senate member when the committee staffs are working. The Kemp-Roth bill was the 30% cut. And Nunn offered a 20% cut and the Senate passed it in 1980 before the election. And I told the Reagan people, have him endorse it. No, we want a 30% cut. Carter is going to kill it, endorse it. So they endorsed it. Not because I said so, but they endorsed it. And Carter killed it, even though the House had voted to instruct its conferees to accept the marginal across-the-board rate cuts to roll back the stagflationary peak of those tax rates. And Carter lost the election. Well, we got it through, and if we can go forward again, and there we go. One of the worst features of the stagflation was the rising tax rates due to inflation. Not only were they hitting the personal income tax rates, but they were, of course, overstating the real capital gains And businesses that were depreciating things over very long periods of time found that their depreciation allowances were losing money, losing value to the time value of money and inflation. You had companies that were actually losing money on an inflation-adjusted basis, reporting taxable profits to the IRS and paying taxes that were in effect over 100% of their income. And Charles Schultz, CEA chairman under Mr. Carter, I asked him about this at one point. He said, "I'd love to do something about that, but we're afraid of the consequences for the deficit." Well, the declining investment and the slipping productivity and the lower wage growth were costing him more revenue than indexing the depreciation allowances ever would have. They were afraid to move. And they were afraid to move when Reagan proposed it. They didn't want to see these base adjustments in their revenue estimates. Everything was static. The president used indexing as one of the features of his bill to explain to the country that this inflation-related series of tax increases was deadly and had to be reversed. Indexing, I sent something over, I sent that picture over with a whole series of formulas to Reagan, and Reagan took it to the White House. And of course the formulas were too complicated to say anything in the evening in front of the public, and I had no idea what he was going to do with it. And Reagan did say to me, "Watch the president's speech tonight," a week later. So I did, and I turned it on, and there he was, pointing at my chart. I went nuts. But what he said there was quite simple. He didn't go through the formulas and the bracket creep and all the rest. He said, "You know, we keep cutting your taxes, but they keep going back up. What's going on here?" He said, "It's inflation, because the tax code's not adjusted for inflation." Well, the Democrats are going to cut your taxes for 2 years and then let inflation raise them back up, and I'm going to cut them for 3 years, and then I'm going to keep them down by having the system adjusted for inflation. So if you want a permanent tax cut, call your congressman. That's a heck of a lot simpler than the gobbledygook I sent over with the secretary. He was the great communicator. The Capitol switchboard was jammed. You couldn't get through. The White House took something like 200,000 phone calls in 2 days. The next day, the Georgia delegation defected. Rostenkowski told the New York Times that he was listening to the president's speech in his office at 9 o'clock that night, and as soon as the president shut up, the phone started ringing in his outer office. And Tip O'Neill said he'd never seen a phone blitz like that. We couldn't have gotten this done the way we got it done without the understanding that Reagan had of the issue and his willingness to take a chance on these things. It really was a chance. I mean, it might not have worked, but we had the Kennedy cuts to support us. We had the 1920s tax cuts to support us. We had increasing academic research to support us, and we went for it. Now, of course, he was told it was voodoo economics, and he was told it was gambling. It was a gambler's roll of the dice, and that was just from the Republicans. But he got it through, and that helped. That communication skill of the president helped a lot. Next, please.